Every week, I spend a lot of time talking to individuals around the country about their concerns when it comes to investments and retirement. One of the largest concerns for most people is what happens if the Trump tax credits expire, meaning who's going to win this election? If Trump wins, they probably continue. If Trump loses, they probably expire. How will this affect you? Give me a second. We'll go over that. So thank you for watching. Now this information is a bit detailed, so I'm going to look at my notes as I talk to you. I know the numbers, but there are a lot of numbers involved. I know people are concerned about it. Let's go back to 2017 when it actually started. Let's take a look at what the numbers were, what we had to deal with at the time. So I think most of us realized that tax credits applied in several different ways. When we say tax credits, the first thing that we would look at is what is my taxable rate? What were the income tax brackets prior to those tax cuts? What are they now? And what are they potentially going to be moving forward? As we go through them here, it didn't change for every single tax bracket. Depending on where you were, maybe some benefited. And this was spun as a way that benefited conservatives, the Republican Party, that benefited corporations, only if you were in a high income tax bracket. I would argue that it benefited most people, depending on what tax bracket when it was lower, not for every tax bracket, for most, but also things like credits and adjustments, not just for wealthy people, but standard deductions. All of this was included, and we have to be very, very careful moving forward. So if you're in a situation where you benefited from the standard deduction because you weren't itemizing it as much, or if you're benefiting because you're in a particular tax bracket that was lowered, it's going to be important. Let's look at some of those numbers right now. So first of all, I don't know this applies to everyone, but the exception would be those that were in the 10% tax bracket, meaning people making less than $11,000 a year, and those in the 35% tax bracket, those earning $231,000, $251 to $578, $125 prior to 2008. Those did not change, but for most people it changed. So the top income tax rate dropped from 39.6% to 37%. Not a huge number, and I know not everyone is in that top tax bracket, but that is important. I think it gets more interesting when we take a look at people filing. So if you were in the 33% tax bracket, meaning if you were a single filer at that point in time in the 33% tax bracket, that dropped to 32. That's not super exciting. But then if you were in the 28% tax bracket filing singly, that dropped to 24%, a little bit more of an impact. If you were in the 25% tax bracket filing singly, that dropped to 22%. So 25 to 22. So depending on where you're at, we have to pay a lot of attention to these tax brackets and how they work moving forward and how things are likely to affect you. Now, I realize not everybody is filing single. Filing married jointly is also very, very important. And I think the reductions are also equally significant moving forward. So basically, for most Americans, if the Trump tax credits expire when it comes to how you file and what tax bracket you're in, you're probably going to be anywhere in between a 1 to a 4% increase in taxes on your net income moving forward. So I don't know anybody who thinks that's a good idea. I realize those numbers aren't huge, but if you're sitting down and you're working on your financial plan, if you're working on your taxes, if you're working on your income moving forward, and you're trying to figure out what tax bracket you fall in, it is important and you have to be careful. So we want to make sure we're very, very efficient there. But I think there are other things, other advantages of those tax cuts that are likely to affect people retired or people close to retirement and potentially a bigger impact. So one of the biggest issues is the standard deduction. So most of us old enough to remember trying to decide whether you're going to do a standard deduction or itemized deduction. Maybe you had that shoebox and you're putting the receipts in and you're trying to figure out what were my donations, what were my charitable contributions, what were my medical bills, and you're saving receipts and receipts and receipts, and you're trying to figure out how do I maximize my tax deduction? Should I do the standard deduction or itemized deduction? There was a point in time where people who had enough in expenses would use the itemized deduction, but there was a lot of time that went into that, but it made sense. Your accountant waited for you to come in with that shoebox with all of the receipts, or maybe you were prepared enough to have it all on a spreadsheet. But point is, should I use itemized or standard? And itemized for a lot of people was higher than the standard, but there was a lot of work that went into that. So what these tax cuts did for most people was it raised the standard deduction to a point where they didn't have to spend time figuring out what their itemized deductions were. And not spending time figuring out what your itemized deductions were means you don't have to pay your accountant to figure them out for you. And it just simplifies the tax process. So part of these tax cuts, the premise was to simplify the tax code. Let's set a standardized tax deduction high enough, whether you're single, whether you're married, filing jointly. Let's get that standard deduction higher than what your potential itemized deduction would be, and make the tax process simpler for most individuals. So prior to the Trump tax cuts, which are due to expire in 2025, if you were single filing, your standard deduction would have been $6,350. If you were filing as head of household, it would have been $9,350. Or if you're married filing jointly, it would have been $12,700. So that was your standard deduction. After the Trump tax cuts, those numbers jumped dramatically. As of 2023, if you're single, filing singly, it jumps from $6,350 to $13,850. That's going to make a big difference if you're filing singly. However, if you're married filing jointly, it's going to jump from $12,700 as of 2023 to $27,700. So those numbers make a big difference to people, whether you're single, whether you're married filing jointly. All of these things make a really, really big difference moving forward. I think the premise of it, certainly, I mean, it's helped individuals, but the idea was to simplify the tax process. And I know some great CPAs out there, but the complication of the tax process is what keeps businesses like any tax preparation business, any CPA, anybody who runs a business off of the complication from the tax code. This simplified that. You could literally be in a situation where you could potentially do your taxes by yourself. There are companies out there that will help you do it online for free. Nothing wrong with paying somebody to do the taxes for you. But if you don't have to figure out your itemized deductions, if you know what your income is, if you know what your standard deduction is, clearly you know if you're single or married. You have to decide whether you're married filing jointly or married filing singly. These options make it much, much simpler. And I think it was a benefit for people moving forward. Another big difference, and this comes up in the financial planning process, is the estate tax exemption. So not everybody's heard of this and not everybody is aware. In the financial services industry, we refer to it as a death tax. It's also referred to as an estate tax. If you've done a great job of accumulating assets, maybe it was because you ran a business. Maybe it's because you were really frugal. Maybe it's because you owned a piece of real estate or even inherited a piece of real estate that just appreciated over time. There's something called a death tax. So what happens is you have your income taxes on your estate. Those don't necessarily pass on to beneficiaries. So there's something called a step-up in basis. If I had investments or if I had a house and if I pass away, right now there's a step-up in basis where I can pass those assets on to my beneficiaries, my children, where they don't have to pay tax on it. I would pay tax, they don't pay tax. But there's a cap on that. The cap is, it's important at a certain point in time. Again, it doesn't apply to everybody. I think that the further we go and the more we have inflation and the more our assets go up and up and up, if you're looking at the stock market, depending on when you're looking at it, it's potentially as high as it's ever been. So your assets in your portfolio are higher. We could argue that's because of inflation. Maybe you own real estate, depending on where it's at, but real estate around the country is going up and up and up. The government is poised to tax you on that if it gets over a certain amount. So let's take a look at that real quick. The Trump tax credits effectively helped individuals that were trying to pass their assets onto their beneficiaries, right? So your children or whomever. So if we go back in 2017, you could pass on $5.49 million as an individual. I know that sounds like a lot of money, but if you've got a business or you've got real estate, it's not necessarily that much for a lot of people. It increased it to 11.18 million. That's a pretty significant increase, and we do talk to individuals that are in this situation. You know, they worked very, very hard, built a business, or they've been passed down real estate time and time again. I think of individuals, pick a state like California. Maybe there was a property, maybe it was coastal, doesn't matter if it's coastal. I mean, it's something that somebody could have paid a couple $100,000 for 20 years ago, and now it's worth way, way more. And the government's coming in and saying, well, you know what? We're going to tax you on that. And what's important about the estate tax or the death tax, it's a very, very high tax rate. It could be as much as 50%. So if they increase that over time, that's important. What the Trump tax cuts did was it took that number of $5.49 million in 2017, increased it to 11.18 million in 2018, and it's been adjusted for inflation over time. So it's gotten to the point where last year in 2023, it was $12.92 million that you could pass to a beneficiary without being subject to the estate tax. And if you're married, filing jointly, that's potentially $25.84 million. So I know that sounds like a lot of money, but I just go back to, how do you feel about your assets and how they've accumulated over time? You've already paid taxes on them. You've already paid taxes on your real estate. You've already paid taxes on your investments. You've already done that. Then you get to a point in time where you've paid all of these taxes. What if the government comes in and then says, all right, well, we're going to take as much as half of that after you've already paid tax? I think it makes sense that people are a little offended by that. When we take a look at what the Trump tax credits did, which are potentially expiring in 2025. This is something else that is potentially a problem, not for everybody, but for many, many people moving forward. And some people might say, hey, I don't care. I don't have $10 million. I don't have $20 million. I don't have $30 million. It's not going to affect me. And I get you when you say that, but the issue is, how do you feel about being taxed on your income? And then on top of that, being taxed on the investments that you've made to have more income. And then on top of that, being taxed on your Social Security income that you've already paid into and is coming back to you. And then at the very end, if you did a good job, then they're going to take potentially half of what you want to pass to beneficiaries. So there are a lot of people that are concerned about that. I think it's has an impact moving forward, and we have to take a look at that. So with that, there are a lot of things that are likely to expire in 2025, depending on who's in office. So potentially, if there's a Trump administration, they extend it. A Harris administration, they don't. We don't know exactly what's going to happen moving forward, but I think when it comes to planning for your investments moving forward, you need to understand the consequence and how you could potentially take advantage of the tax credits if they continue, but how you protect yourself if they don't. Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.